Good afternoon for everybody. I'm glad to see all of you here on Investment Academy. And let's recall the main moments of our first webinar. Uh, let's look once again at this slide. We examine growing risk when global economy using cheap money. And it's really could be a great damage for your investments when S&P 500 index in a record high, but quarterly GDP numbers every time lower since 2014. You see. And second picture. We also refreshed our historical memory. We remember Dow Jones 1928, 1929. Now we are more conservative. Now we understand that the first aim is to preserve our capital. If we are clever investors and we know how to preserve capital, the question of profit is a question of time. And finally, the sense of previous webinar is to show that all possible on the financial markets. All of our predictions or our assurances are only probability. Also, the greatest analytics may be wrong, and even it happens too often. So, for you such a mistake could be fatal when you fall with your money, in one idea for example, or in one asset manager. And once again, only few effective things we can to do are controlling our risks through clever diversification, choose best timing for investments, and to build competent and official financial plan with aims, expectations, and risks. Okay, let's begin our second webinar. Before we will learn how to build financial plan and variations how to invest money into asset manager or into market, I will introduce basic conceptions and definitions of the market sphere. That gives you basic knowledges of main instruments and infrastructure on the market and possibilities to know about market more and to speak the same language with the asset manager. So our theme today is instruments and infrastructure of financial markets. Okay, let's look at this picture. Okay, let's begin with a short preview of the main markets participants and instruments. We can conditionally divide all instruments in two groups: basic instruments and derivatives. In other words, derivatives are instruments based on basic instrument. So we have spot market where circulated shares, obligations, bills and checks, commodities and currencies. And derivatives instruments based on spot market instrument. There are ADR, futures, forwards, options, currency contracts, indexes. We see it here, futures market. Finally, let's look to infrastructure. Those links that gives an opportunity to organize all the processes well, from trader to exchange. And now we will examine all these components of the financial market in more detail. And let's begin with infrastructure that allows us to realize deals. In other words, find another person who will buy or cover our shares when we decided to open or to fix our deal. So, There are two kinds of participants: professional and non-professional. Professional participants we name those who constitute organizational part of trades, and they create conditions which meet demand and supply, provides our deals, helps to support liquidity, defines mutual obligations of market participants. There are exchange, brokers, market makers, clearing houses, asset managers, and others. Let's start with exchange or bourse. So it's legal entity which is responsible for the functioning of organized market, commodities, shares, securities, and derivatives. It's a place where creating liquidity and where someone who want to buy can find a person who want to sell, and controversy. We can pick out two main exchanges: stock exchange such as NYSE, Nasdaq in USA, Euronext in Europe, and exchanges, for example, in Tokyo, Singapore, etc. And second one is commodities exchange, such as commodities exchange in Chicago. Another type of market of the board market. This is decentralized network of dealers buying and selling equities and offering the possibility to participate in deals with securities through electronic tools. This market often for such shares that have not passed listing into the main exchange, because it's too tough requirements to pass the listing. Thus, so the board market is less transparent and it's riskier to trade on it. Dealer is a professional participant of the financial market who trades by its own money and from his own name. The brokerage firm. The brokerage firm is a professional participant who provides transactions from client to exchange or to liquidity supplier. For such transactions, broker receives commissions. At Forex, for example, some traders think that spread is the main profit of the brokerage firm. Sometimes it's true, but it's better when you have tight spreads but paying commissions, because in such a way you can more accurately and easily calculate your risks. It's also useful to know difference between A-book and B-book broker. In fact, B-book broker, it's a kitchen broker or bookmaker. So your deals are not delivered into interbank and hold inside a B-book company. As a result, for company, it's interesting that you lost your money. A book broker exceptionally generates profit from traders' commissions and develops orders into exchange or liquidity supplier. At Forex, liquidity supplier is usually prime brokers such as largest banks. For example, Deutsche Bank, JP Morgan, Citibank, Bank of America. Thus, for a book's broker, it's interesting their clients have a long, profitable life at trading. It's often you can hear an opinion that market maker is someone such as puppeteer and act against trader positions. So you must know well the definition and role of the market maker. Market maker is a company that takes a risk of holding equities on its accounts, aimed to organize sales and maintain liquidity. According with the contract with the exchange, it can be a broker or dealer. In other words, if you want to buy an instrument or share but can't meet a seller at your direct price, that task exactly can be performed by the market maker in frames of agreements with exchange. Thus, to support liquidity, market maker is acting on both sides, as a buyer and as a seller. But you need to remember that when a big disbalance will appear, for example after key news, market maker will support price far from your direct price, and spreads will widen at this moment until the wave of one-sided aggressive buyers or sellers will not cease, because nobody wants to lose money. Now imagine that 80% of traders want to buy instrument at price 101, but only 20% of orders can be satisfied by this price. The next sellers stay at price 104. What's happened? So this is disbalance, and it's easier to support liquidity in instruments with higher daily trade volumes. So the rule is simple: then less volumes in instruments, the bigger chance that you will not receive your direct price. And those who thinks that someone manipulate with quotations or act as a puppeteer, I can say that for such price manipulations you need too large capital. But large capitals always will leave footprints at the chart, because it's very hard to act discreetly with a large capital. If you understand the financial market enough good, it's even your advantage, and you can use it for making profits. Clearinghouse. Clearinghouse is a professional participant in financial markets that defines mutual obligations according to committed transactions. Clearinghouses exist in frames of exchange and gathers information about committed deals, accounting of transactions, ensuring delivery of securities, and finally organize cash settlement. Share. Share is an emissive security that fixed the right of its owner or shareholder to pretend for the part of the profit of the company as dividend. Shares always attract investors and traders while hunting for profits. It's a lot of styles of trading here, starting from intraday trading and finishing to build shares portfolio. But in every style of investing, you need knowledges and experience. For example, in intraday trading, you need to understand good your idea, your advantage, and mathematical part of your trading system. You need to be emotional stable. In investment strategies, you must accurately calculate your risks, make diversifications, and choose best timing. Because if you choose bad timing and market fall down, dividends will be only modest compensation from drawdown of your capital. Do you remember this chart from previous webinar? It's Nikkei. Imagine you invest at bad time in 90. How to do it more accurately? When to invest your money and how to diversify it? We will speak more detailedly in next webinar, but you must remember this picture and to know that bad timing is very dangerous for your portfolio. Okay, let's look at the next picture. It's ADR, American Depository Receipt. So you also can find foreign shares at American market from China, from Great Britain, from Russia, etc. And this is a ADR, American Depository Receipt. that represents a foreign share as a derivative in USA stock market. You can trade these shares equally as shares from American market. Okay. So investors consider then the most conservative instrument at financial markets after banking deposits are bonds. Bonds emission debt security that fixed the right of its owner to receive interest, fixed or floating, payable at fixed intervals. At the end of their circulation will return nominal value of this security. So you can expect more profit from bonds than from banking deposit, and also it can be a part of your investment portfolio. Lately, traders even use bonds as a short-term speculative instrument. Okay. Next slide. And here all simple. Promissory note is a security that gives the right to obtain from a debtor a certain sum in the bill. Check a security as an order to make a payment of the mentioned sum in the document to check holder. The drawer of the check is a person who has money in the bank. So maybe you will not use this instrument in your direct trading, but it's also useful to know as a part of financial system, and probably you will use it in your future. Let's look at the next picture, and this is a S&P 500. We touched it in previous webinar, and now it's time to give a definition what is S&P 500 and other indexes. So stock index is a composite index, essentially equities portfolio weighting in a certain way. It's a very interesting instrument available at exchange and even at Forex as CFD. In other words, this is portfolio of shares. For example, S&P 500 is a portfolio of 500 largest companies. Index can be as a speculative and also as investment instrument. The main advantage is large liquidity and diversification that saves you and your portfolio from big price gaps, as it can be happened in separate shares. Futures. Futures are derivative financial instruments on the stock exchange, a kind of forward based on spot market instruments. This is a contract in which one party undertakes to transfer the goods, the basic asset, for other party, or to fulfill alternative monetary obligations in frames of certain period. Futures gives you more leverage, limited by time, less expensive paying commissions than to buy shares, and of course is a speculative instrument. Options. This is the derivative that fixed the right but not obligation to buy or sell the asset according to a predetermined price and moment in the future. This is European option, or during the certain time, American option. Often options used as insurance when holding stocks, but existing strategies to use options as a separate instrument for trading. But it's separate thing. It's more riskier, and I advise to learn one thing, but to know it good. It's better than to know a lot of instruments and to know they bad. Okay, now we touch Forex. Forex or a fixed foreign exchange. Forex is a Forex is a currency market which joins institutions all over the world. Forex is a decentralized market, so all the deals made through dealers and banks without clearing houses and exchange. But the main difference from off-the-board market is accurately quotations that comes from interbanking trades through such systems as EBS and raters. So, difference from dealers can differ on the value of the spreads. What is the main difference of Forex from exchange? Yes, of course, on the stocks market, a wide variety of shares that makes for every day a lot of ideas for trade. For investors, this is deep diversification for shares portfolio. It means that if you are trading on the stock market, you need more time to prepare and choosing carefully your ideas. At Forex market is not so much instruments, and the most difficult for traders is only be active when you have your trading situation, when you have an advantage. So waiting is the most difficult thing. But contrary, limited quantity of instruments gives you an opportunity to know each instrument well. So Forex today is the fastest growing and liquid market. For example, daily volume in 1977 were approximate at $5 billion USA. In 2016, daily volume is more than 7 trillion US dollars. What are the benefits from the liquidity for traders? There are possibilities to get out from current trade at the most accurate price. Another plus on the Forex is always allows a short sale without trade restrictions, such as the stock market. For example, at stock market exists an uptick rule when you can short only when price uptick. Next, difference in Forex, high value of leverage, which can significantly increase profits when you can clearly calculate your risks. But also, it's huge risk of unthinking trades when you can't understand principles of such leverage. So, another plus that in Forex price gaps occur less than at stock market, and that allows to calculate your risk and profits more accurately. Imagine you have a position on 100 shares at price 10 and 2 cents and planning to leave it at price 9.99. So your risk is 3 cents or $3. But next day at morning you find disbalance between buyers and sellers and price open at 7.02 and you leave your position at 7.02. So instead of losing $3, you lose $300. At Forex, price gaps can appear after holidays because it's 24 hours market and price gaps can appear maybe during key news. So finally, today we have discussed the basic instruments and about infrastructure of financial markets. Let's show now. Whether you choose the path of the trader or you will choose the path of investor, in any case, it's very useful to know features of the market and at least to speak the same financial language and understand what discussion about. I wish you a good day. Thank you for your attention and see you in our next webinars on Investment Academy.